U.S. stocks have been just the hottest thing in the world.
Even with U.S. markets reaching new highs, that global sentiment seems to be changing.
Foreign stocks have started catching up.
For the first time in decades, foreign stocks are outperforming the U.S.
The dollar's down about 10% since the start of the year.
It's why retail investors should really be looking at adding international investments.
I think there's a real reason to say, hey, I got to watch out for this home country bias.
Matt Weinschenk from Stansberry Research shares a list of 3 international investments you should be looking at.
Shares are at like $30 today. I see them going to 50 on that. I mean, this could be up to 80 in a year or two.
The international investing information you won't want to miss. Let's dive in. Matt, so great to have you with us today, talking about the importance of paying attention to international markets, especially right now. The US might be celebrating our own new record highs right now, but a lot of countries are doing even better. All foreign markets combined are up about 15% this year, but individual countries like South Korea are seeing gains as high as nearly 40%. That compared to the US record high, that really is only a growth of about 5%. So, Matt, starting with all of those numbers, just to show this is something retail investors should really be paying attention to and really looking at adding some international diversification to their portfolios.
Yeah, and so it is important both for diversification and I think there's reasons why you want to own international stocks right now. So let me start with a mistake that so many investors make because it tells the whole story of international investing. And that's something called home country bias. And if you go country to country and you look at people's brokerage account or retirement accounts, they tend to own too much of the stocks of their own country, right? So, this is all over the world, but in the U.S. stock market is about 60% of the total global stock market. So in theory, if you want a nice global portfolio, you should allocate 60% to the U.S. But most U.S. investors have something like 80 to 85% in U.S. stocks. So they're overweight U.S. stocks. But if you followed that advice for the last 10 or 15 years, it would have worked out terribly for you because U.S. stocks have been just the hottest thing in the world. They've completely beaten the rest of the world. They've outpaced them. The dollar's outpaced them. So if you were a smart investor, it's actually wouldn't have gone well for you. But I think those things are going to turn around. And I think there's a real reason to say, hey, I got to watch out for this home country bias and start looking at these international markets.
And that's a really interesting point that if you had followed that weight heavy on American stocks, you'd be doing really, really well right now. So the question is, what's changed? Why now? If in the past it's worked so well to stay in just American stocks, why do you think right now is the time that we should be adding some of these international stocks to your portfolio?
So first you want to say, like, why did they perform so well, right? Because we want to see if that's going to continue. And, the U.S., we're not the fastest growing economy, but we're very stable. We're dynamic. We've got the best businesses in the world. We've got free markets. It's all great for our economy. The dollar has been very hot. So if you are a foreign investor owning U.S. stocks and the dollar's going up too, that's an extra benefit. And then the performance of the last few years has been so much in large cap tech stocks, which is what the U.S. is really best at. I mean, we obviously dominate that. But what's changing now? It's not just tariffs, but it really does kind of stem from tariffs in that the U.S. is taking a more adversarial position in international trade. And there's concerns about what is this going to have inflation? There's concerns about central bank independence. So other countries are looking for ways to not make the U.S. the center of their global economy. They want to get a little bit outside the dollar. They want to have their own local trading partners. They want to have their own manufacturing. And so that is enough to have them start looking at other currencies and at other markets. And so that's going to change the way capital has been flowing. So since 2006, there's something called the net international investment position. And that shows us that foreign investments in the U.S. have outpaced U.S. investments in foreign assets by $26 trillion. So all this foreign capital has been flowing into the U.S., driving up our stocks, driving up our dollar, but the foreign companies aren't going to put up with it anymore.
Yeah, have we seen that change happen already? Are we already seeing some of that data coming in where we're seeing foreign money going elsewhere?
Yeah, absolutely. So, and you can see it in some headline numbers. The dollar's down about 10% since the start of the year. And also, interest rates are up because investors are pulling their money out of U.S. bonds, and that's a particularly strong piece of evidence because usually interest rates go up, the dollar goes up because people want to buy our bonds. They need to buy the dollar. The interest rate looks more appealing. So the fact that they're diverging is a really strong proof point that the capital's moving out of the U.S.
That's a concerning stat, and also why we are looking at these international markets and ways that you can invest. I know Stansberry Research is all about research and the numbers. You're the head of research, Matt, so I know that you dive into numbers all the time, but
Mhm.
that those numbers lead you to stock recommendations. And you can find weekly recommendations from Matt and his team at Stansberry Research by signing up for his newsletter This Week on Wall Street. There's a lot of great information here. You just have to scan the QR code or click the link in the description of this video to learn more. But Matt, for today, you have a list just for our YouTube viewers on 3 international investments you could add to really take advantage of all the growth happening in these markets.
Yes. So I do want to make this easy for people. You can do these on U.S. exchanges. It's not that complicated. And the easiest way to get some foreign exposure is a fund called the Cambria Foreign Shareholder Yield Fund. Its ticker is FYLD. And the basis of this is what's called shareholder yield. And this is a great way to find fundamentally sound investments. And shareholder yield is basically stocks return capital to shareholders through dividends. So they have a yield. But also, repurchasing shares is a way to return capital to shareholders. So is paying down debt. So if a company has a 2% dividend yield and they buy back 3% of their shares, they're really yielding their shareholders 5% a year. So this is a great way to find long-term fundamental investments. Meb Faber of Cambria Investments has a whole book on this. It's a great book. But what the foreign shareholder yield fund does is it applies that quantitative strategy. It buys 100 stocks in foreign markets that have the highest shareholder yields. And so it ends up owning things like Orange, the French telecom company, and Canadian Utilities and the Bank of Ireland. And country-wise, it's a lot of Japan, UK, France, Canada. So it's not wild emerging markets or frontier markets, as they call them. These are stable companies, big dividends, big yields. Uh, and it currently yields for income investors, it yields about 6% dividends, very low expense ratio. It's a great way to just take one click, own a bunch of foreign companies that are all, sorted for quality. So you know that you're getting good investments, nothing that's too speculative.
That's a really easy, straightforward way to get some international exposure, like you said. I think one thing I want to cover with this is how much growth can investors expect in a fund like this?
Shareholder yield is a really good proxy for what shares will return over time. So, if you look at a dividend stock, you'll say, "Oh, I'll earn 3% a year," but there's other things going on. So, actually, just looking at the shareholder yield is a great indicator of this. Under normal conditions, these fundamental companies are going to return something like 10, 12, 15% a year because that's what they're yielding. Now, if this trend towards international stocks takes on, that's going to boost their valuations. That's going to boost their multiples. So you can get something faster than that. And this fund is already up 20% year to date, which is a great performance. But again, that's just the start after a long, decades-long period of international stock underperformance.
Oh, this is a good first pick of a way to invest in international stocks. Really easy because it's right in a fund for you.
Mhm.
But now let's move on to an individual stock that's a familiar name for a lot of American investors.
One foreign stock that I think is really appealing is BP. And that seems almost like an American company, but BP used to stand for British Petroleum, right? This is a global oil super major, but it gets about half of its production and about 60% of its revenue from outside the US. So we're stepping into an international stock. It's not too dramatic, but we're getting that exposure to the rest of the world. The other thing that's important about BP is that it's a commodity play, right? Obviously, it sells oil, and if you're concerned about the dollar, owning commodities is a way to insulate yourself because a barrel of oil costs $70 Brent crude today. If the dollar gets weaker, you're going to have to spend more dollars to buy that same barrel of oil, so the price of oil goes up, right? That's why commodities are great when you're concerned about currencies. BP's particular story is that they've been lagging behind their competitors for the last few years. They've been underperforming Shell. Their valuation is about 30% less than Shell, which is a really good comparison for them. And the reason for that is they took this big turn into renewable energy, 2020 to 2025. That was their plan. And look, I love renewable energy. I hope it works out. But for BP, it was leading them to invest in projects that were lower returns on their capital. So it was dragging down their financial results. But they've got a new CEO, they've got a new board. They're dropping that plan and they're going to change going forward, selling off a bunch of renewable stuff. It's going to almost automatically increase their free cash flow. Shares are at like $30 today. I see them going to 50 on that. If they can get a valuation like their competitors, I mean, this could be up to 80 in a year or two. So it's a very interesting turnaround plan for BP.
A really interesting growth potential for this one. And also, I think that familiarity for investors also helps that, it might be an international exposure, but it's a company that's in America. It's something they're familiar with. And I think that leads investors to feel a little bit more comfortable with a pick like that. Let's move on to the third name you have on your list. And this one is probably going to be more new for investors.
Yeah, it may not be a name you know, but the company's called ASML. It's a very large company, and this is an AI play. So AI is obviously very hot, and the stocks are getting expensive. Not ASML so much, but if you want some more AI exposure, this is the name I like. They're based in the Netherlands, and they get 80% of their revenue from non-US sources. So we're talking about building more chips in the US, but this is still mostly China, South Korea, Japan is where they get the revenue from. So let me explain where they fit in this semiconductor cycle, right? You have NVIDIA that designs chips, and then they hire companies like Taiwan Semi to actually manufacture them because it's very difficult to manufacture. But ASML actually makes the equipment that goes into the Taiwan Semiconductor factory. So this is like the most challenging technical thing you can do. These machines cost hundreds of millions of dollars. They have to load them up on more than 20 trucks to bring them to the customer. It's extremely complicated. There's only a few companies that can do this. And that means they have really good profit margins, right? They're earning like 30% a year. They're probably going to grow double digits. They just took a dip on some news this week. And so that's a nice buying opportunity. And it trades at like 24 times earnings, which is about the same as the S&P 500. So you're getting like an AI play at a market price here. It's just the most difficult thing you can do. And that makes them a lot of money. So it's a really interesting way to play AI without worrying about software or NVIDIA's valuation.
And some investors who are really into AI have definitely heard of this company before because, like you said, there's not a lot of competition. There's not a lot of names doing what they do. But I do think one interesting question with this one and kind of applies to the rest of this concept of investing in more international stock picks. It's an interesting time to do that because the American AI plays are doing so well. NVIDIA hitting another all time high. Really, the whole market in the US doing so well right now. So I think some investors watching this might be thinking, well, why would I need some extra exposure right now when American stocks are doing so well?
Yes. Well, foreign stocks have started catching up since really the sort of the tariff news. Foreign stocks have been doing well. In the broader sense, there's so much concentration in these big AI names, these big tech names. They make up 30% of the index or something like that, and they've continued to outperform. But when I see that concentration, that makes me think about the downside. That makes me think about the risk. If investors start to get wary of these hundreds of billions of capex that they're putting into these AI projects that aren't creating that much revenue yet, and you own the S&P index fund, you are very concentrating these things in a way that you might think you're diversified in the index, but it's quite concentrated. So to me, that makes me worry. I want to have my AI bets. I love these things, but I want to get a little international. I want to get a little more small cap because those things are great on the way up, but concentration hurts you just as much on the way down. So
A really good advice for investors to consider on diversifying, especially in the tech sector. Let's talk about just adding international stocks in general. How much of your portfolio should be in international stocks?
well, if you want to follow the global market, you want to have about 40% in international stocks. Now, You don't have to quite do that. America is still great. What's interesting about that home country bias is if you look at Canada, Canadians own too many Canadian stocks, right? That doesn't seem like a smart idea. Like we do have a benefit of being the US, and it does make sense to own a little bit more. So, I mean, I think it depends on your goals and everything, but I think at least 30% should be in US stocks. I knew the home country bias rules. I have been in international stocks and I have suffered because of this US outperformance. But 30, at least 25%, I think should be outside the US. And if you're an active investor, this is the opportunity to look at now and put a little bit extra in, outside your tactical allocation should be a little bit more than your long-term strategic allocation, so to speak.
I have one more kind of devil's advocate question, and that's on, can you just ignore countries? Can you really just look at the company itself, what it's producing, what it's making, how successful this company might be without really paying attention to where is this company based?
Yes, that's the way I like to invest. I think bottom up is the best, right? You take a business, you look at it almost in isolation, and you bet on that. Now, so many companies are crossing borders, right? So many companies are working in different industries, so there's not that many like pure plays. Like you can look at real estate companies in the UK, right? They are stuck in their country, right? They are going to rise and fall with the UK economy. So that's something that you have to know the macroeconomics of that country. But if you have a consumer company, a technology company that's in a different country, I think you want to look bottom up. You want to judge that business. And that's really a question of your investing style. But I think that's the right way to do it.
All right, really good advice for investors today, Matt. Thank you so much for this discussion on international stocks. Let us know what you think in the comments. Are there any international plays that have been performing really well for your portfolio this year? Other countries that you're looking at and you want to know more about? We'd love to hear from you in the comments again. Thanks for watching, everyone. And as always, happy investing.